Hello guys, this is the third lecture in managerial accounting, and we stopped for the last time in analyzing the mixed costs using the scatter graph plot and the high-low method. So let's discuss now the analyzing the mixed cost. And if you remember, we have two kinds of costs for the mixed cost. We have the variable cost and the fixed cost. Actually, the mixed cost starts with the fixed cost, and then it will become variable. So now we have to discuss the mixed costs. The first method to discuss the mixed cost is the scatter graph plots. An example: assume the following hours of maintenance work and the total maintenance cost for 6 months. We have 6 months and we have hours of maintenance, number of hours of maintenance, and the total cost for this maintenance cost. Okay, the cost of the maintenance or the expense that we have to pay for the maintenance from January to June. Now, the scatter graph method means to put or to represent each hours and its cost. So we have an x-axis and y-axis. The x-axis contains the hours of maintenance. We can classify the x-axis into hundreds, starting from the minimum, which is less than 450, which is, if you like, go back to the question. This is 450 in February, so we can start with 400 and classify the x-axis into hundreds. So 400, 500, 600, and so on. The y-axis, we will see the minimum cost for the from the question, total maintenance cost. So we have 7,400 the minimum. So we can classify the y-axis from 7,000 up to 10,000, which exceeds the maximum one. So plot the data points on a graph. Total cost y, which is called the dependent variable, versus the activity, which is the independent variable x, represents the hours of maintenance. Now we will plot. Plot means we will join the hours of maintenance with its cost. So go back to the first plot. We will see the minimum or the 450 with the $7,400, and we need the first plot here, 450 with the 7,400. The second one will be the 550 of April with 7,625, and we would put a plot joining the two amounts. The third one will be 625 with 7,950 in the graph, and at the end of the 6 months we have 6 plots represent the 6 months, and after that we can draw a line joining these plots. This is called the scatter graph method. If we have more numbers or data, then we have a linear graph. In this way, in this let's say method, we can draw a line between the points. In this case, we can predict our future for the maintenance cost. More important, which is the other method, which is called the high-low method. High-low method. Depending on the same example, depending on the same data, we have 6 months, hours of maintenance, and the total maintenance cost. The most important here, or the key for the high-low method, we will choose only two amounts. The lowest level of activity and the highest level of activity. Then, before doing anything, we will choose the highest level and the lowest level of activity. Activity means here the hours of maintenance, okay? And the lowest hours of maintenance will be for February, which is 450. The highest level of activity will be for June, 850. Now, we will choose these two levels only to predict our expenses for the future, okay? Then we will choose the total maintenance cost for these two levels only. So the number related to the lowest is $7,400, and the number, which is the cost, related to the highest is $9,800. Now be careful, these two numbers, which is the cost, it is not important to be the highest and the lowest. Instead, we use the highest level and the lowest level. Now we choose the hours of maintenance, the lowest number and the highest number. 450 is or was the lowest number for the hours of maintenance, and the 850 was the highest number of hours of maintenance. And then we will choose the costs related to these two levels. Second, we will calculate the difference or the change between the costs, these two costs, and the change between these two levels or hours of maintenance. The change of the costs divided by the change of the activity will equals to the variable cost per 1 hour or 1 unit. So the variable cost per 1 hour of maintenance is equal to the change in cost divided by the change in hours. Remember the equation, which is y equals a plus bx. And if you remember, we said that these or this equation represent the mixed cost. If you remember, the y represent the mixed cost, the a represent the fixed cost, the bx represent the variable cost. Then if we apply this equation, then we will say the total fixed cost is equal to total cost minus total variable cost. The equation starts with the total cost, if you like. The total cost y is equal to total fixed cost a plus total variable cost, which is bx. Now, if we need to calculate one of them, then we will move forward. Before that, I will go back to the calculation for the variable cost per unit, which is represented by the b in the equation. So again, the variable cost per 1 hour is equal to the change in the cost divided by the change in the activity. So 2,400 is the difference between 9,800 and 7,400 divided by the change in the activity, which is 850 minus 450. And this equals to $6 per hour. Remember from previous lectures that the cost per 1 unit or the variable cost per 1 unit is constant. Again, the variable cost per 1 unit is constant, which means the cost per 1 table, if you remember the example, we need $4 to buy the wood per table. So this will be constant. So again, the B will be constant for the equation. Now, if we apply one of the levels for the equation, remember that we do have the total costs, the total maintenance cost, which is the mixed cost in this case. And we have the levels or the activity level, which is the hours of maintenance. And we have now the variable cost per 1 unit. Now, we will apply the equation for one of the levels, either the high level or the highest level, and the lowest or the lowest level, okay? If we apply the equation for the highest level, the highest level means we need the 9,800 and the 850 as an activity level. And then we will say y equals a plus bx. Okay, I'm reminding you about the equation, the original equation. Y is equal to the total cost, a is equal to the fixed cost, and the bx, b times x equals to the total variable cost. Now, apply this equation to the highest level. The total cost will be 9,800. The fixed cost is missing until now, so we need to calculate the fixed cost from the equation. Plus, the total variable cost means the variable cost per 1 unit multiplied by the level of activity. We just calculated the variable cost per 1 unit, which is $6 per 1 hour, multiplied by the level related to the highest level, which is 850 hours. Okay, so 6 times 850, which equals to 5,100. If we move this number, the total variable cost, to the other side, then the fixed cost will be equals to 9,800 minus 5,100. This equals to $4,700. Now we have all, or calculate all the whole components for the equation. The total cost will be 9,800. The variable parts of this cost will be 5,100, and the fixed part of this cost will be 4,700. If we apply the lowest level, we have to have the same total fixed cost. Remember that the fixed cost will be constant for the company, right? So if we apply again the equation y equals a plus bx for the lowest level, the y, which is the total cost, will equals to what in this case? 7,400, right? 7,400. This equals to what? A, which is missing, plus B equals to $6 per 1 hour, multiplied by what? Multiplied by the level related to the lowest cost, the lowest level. The hours of maintenance related to the lowest level, which is 450. Now, if you calculate the variable cost, this equals to 6 multiplied by 450, which equals to 2,700. So the fixed cost in this case will be 7,400 minus 2,700. 7,400 minus 2,700. This equals to 4,700. Again, compare this number with the number that we calculate depending on the highest level. It should be the same number. Why? Because we are talking about total fixed cost, total fixed cost. So the number should be the same. Either you use the highest level or the lowest level. Okay. Remember that this equation is applied only for this company. So this is valid for this company only. So we can summarize the equation for this company by saying this company will use the equation y equals 4,700 plus 6x, which means if we need to predict any maintenance cost for the future, then we have to pay the fixed cost plus $6 depending on the hours of maintenance. So 4,700 is the fixed cost, 6 is the variable cost per 1 unit, and the x is the level of activity. Again, this equation or cost equation of maintenance is valid only for this company. If we have a level or hours of maintenance not mentioned in these months, which means I'm talking about the future. If you need to predict what is the maintenance for the future, we can predict depending on this equation. We will pay $4,700 in all cases. Why? Because this will be the fixed cost, and we will pay $6 depending on the level of activity. Check, a quick check. Sales salaries and commissions are 10,000 when 80,000 units are sold. $10,000, which is a cost if we sell 80,000 units, and $14,000 if we sell 120,000 units. Using the high-low method, what is the variable portion of the sales salaries and commission? Here, they give me only the highest and the lowest level, which is 80 and 120, and the costs related to these two levels. So what is required from the question is the variable portion of the sales salaries and commission per 1 unit. So how to calculate the variable cost per 1 unit is simply to say the change in the costs divided by the change in the units. So we have to say 14,000 minus 10,000 divided by 120,000 minus 80,000. This equals to what? The cost change is 4,000 divided by the units or activity change, which is 40,000. So 4,000 divided by 40,000 units, and this equals to $0.1 per 1 unit, okay? Or 10 cents per 1 unit. This is a variable cost per 1 unit. Using the same question, calculate the fixed portion for the sales salaries and commissions. We have to use the equation now. So we will say y equals a plus bx. Use one of the levels, not the two, because definitely you will have the same answer. So if we use the highest level, in this case, highest level, we will say that y equals 14,000 equals a is missing, which is the fixed cost, plus 0.1 is the variable cost per 1 unit, which is b, multiplied by the level related to the 14,000, which is 120,000. The 0.1 multiplied by 120,000 is equal to 12,000. So the A, which is the fixed cost, is equal to 14,000 minus 12,000. This equals to 2,000. So the fixed cost answer is 2,000. Depending on the equation, y is equal to a plus bx. Definitely, if we use the other level, we will have the same answer. The least square or least squares regression model or method, a method used to analyze the mixed cost if a scatter graph plot reveals an approximately linear relationship between the x and y variables. This method uses all of data points to estimate the fixed and the variable cost components for the mixed cost. The goal of this method is to fit a straight line to the data that minimizes the errors. Definitely, this is used by a software or the huge number of points or data. They have to use the least square regression model, and we cannot use the scatter graph. Software can be used to fit a regression line through the data points. The cost analysis objective the same. Y is equal to a plus bx. The regression or least squares regression model provides a statistic called R square, which is a measure of goodness of fit of the regression line to the data points. Statistically, in research, we use the least squares regression model, definitely. And if you like, because we are using more data, this will be more accurate. The two methods just discussed provide different estimates of the fixed and variable cost components of the mixed cost. This is to be expected because each method uses different amounts of data points to provide estimates. The least squares regression provides more accurate. Why? Because they use all points or all data available. Learning objective number 5, understanding the cost classifications used in making decisions, relevant costs and irrelevant costs. Decisions involve choosing between alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to a decision. To make decisions, it is essential to have a grasp on the concepts of something called differential costs and revenues, opportunity cost, and sunk costs. Let's discuss what is the definition of each of these three. The first one is called differential costs or incremental costs. And definitely we will use these incremental costs and revenues in the last chapter 14. The differential word is the difference in costs between two alternatives. So if we say a difference in revenue between two alternatives, we are talking about differential revenue or revenues. Differences between two costs, we will say differential costs between two alternatives. Both are always relevant to the decisions. Differential costs can be either fixed or variable. Simply, the word differential costs are the difference between two costs or two alternatives costs. The differential revenues is the difference between revenue in alternative 1 and revenue in alternative 2. The word opportunity cost, which is the potential benefit that is given up when one alternative is selected over another. These costs are not usually found in accounting records, but must be explicitly considered in every decision. If we choose to invest in alternative A, then we definitely discuss the alternatives between A, B, C, let's say, and we choose A. So what is the forfeited, what is the given up, what is the second choice that we given up or lose? This is called the opportunity cost. Suppose that we were discussing to choose between A and B, then the B will be the opportunity cost. For students, what is the opportunity cost you incur by attending the class? So what you are forfeited, what you are given up if you choose to join the university, this is the opportunity cost. The word sunk cost, go back to the opportunity cost just to have a comment about these costs are not usually found in accounting records. Yes, because if we choose A, then all of our numbers in accounting, we are talking about A in our financial statements, but we will not mention the cost of B, let's say, referring to the opportunity cost, because we are not using it in our records. We've given up the choice B by choosing the choice A. So you will not find the numbers related to the choice B. Why? Because we've given up choice B because we choose choice A. Then our numbers will contain the costs related to choice A, but definitely we will use the numbers of B or the costs of B in choosing for the alternatives. So we will not see accounting records about the opportunity cost, but it is explicitly considered in our decision when we choose between A and B. The word sunk cost, which means these costs which is already been incurred and cannot be changed now or in the future. Something happened in the back in the history, like I pay a cost for my car 6 years ago. Okay, so if my decision now to travel by car or by train, the cost of my car will be a sunk cost because it will not change my decision. So this is called a sunk cost. These costs are irrelevant and should be ignored when making decisions because it is sunk or happened in the history. Suppose you are trying to decide whether to drive or to take a train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant for this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take a train to Portland? Definitely, yes, it is relevant. Why? Because if, let's say, to drive is cheaper than the train ticket, maybe I will choose to drive, right? So if the word relevant is important and you have to say the relevant word, if my decision affected by this information, this will be relevant. If my decision does not affect by this information will be irrelevant. The train ticket price will affect my decision. Then I will say, yes, it is relevant because it affects my decision. So the cost of the train ticket is relevant for this decision. Quick check number 4. Suppose you are trying to decide whether to drive or take the train to Portland. You have ample cash to do, but you don't want to. If we are talking about annual cost of licensing your car, is the annual cost of licensing your car relevant in this decision? For a decision if we choose to drive or to have a train, and I'm thinking about the annual licensing of my car, this will be relevant? No, because my decision will not be changed if the license or for depending on the license of my car. So this will be not relevant because it will not change my decision. It will not affect my decision to drive or to have a train for Portland. Then we will say it is not relevant in this case. Quick check 5. Suppose that your car could be sold now for 5,000. Is this a sunk cost? Be careful, I'm talking about 5,000 now, which is called the market price or the fair market price of my car. Is it a sunk cost? No. If we say sunk, means something happened in the back, in the history. The cost for my car can be a sunk cost, but the price of my car now is not a sunk cost. We are talking about the fair market value or the price that I can get from selling my car now. So this is not a sunk cost. If I have a good price, then maybe I will sell my car. This will be relevant, which means it is not a sunk cost. Okay. Learning objective number 6, prepare income statements for merchandising company using the traditional and contribution formats. This is an interesting topic. We heard about the traditional way to prepare our income statement, and maybe the contribution format will be new for our chapter. Let me remind you about the traditional format to prepare the income statement. Traditional format for the income statement. I'm reading in the left side of the income statement. Traditional format. If you remember, we prepare our income statement starting with the sales for a merchandising. and manufacturing, by the way. Sales 400,000 minus the cost of goods sold for 70,000. These numbers are given. The difference between these two, called gross margin, 100 minus 70 will equals to 30,000, minus the selling and administrative expenses for 20,000, and this equals to 10,000 as net operating income or net income. This was the traditional format. We learn about the traditional format in principles of accounting. So sales minus cost of goods sold equals gross margin minus selling and administrative expenses, and this equals to net income or net operating income. And usually we have to use this traditional format for our reporting for external users. So if we prepare an income statement, definitely we have to use the traditional way in disclosing our income statement for external reporting according to the international standards of accounting. We have another format called contribution format, and this is used for internal users, which is for managers. And we will use this contribution format in the next chapter, and we will discuss the importance of the contribution format for decision making by the managers. The contribution format will start with the sales 400,000, but we will consider only variable expenses to calculate something called contribution margin. The word contribution margin simply is the difference between the revenues and the variable expenses only. Variable expenses only. So revenues, which is sales or sales revenues, 100,000, minus variable expenses for 60,000. So out of 70,000, we have 60 variable and 10 fixed. For the contribution format income statement, we have to use the variable expenses only for this calculation in order to calculate something important called contribution margin. In other words, how the variable cost contributes in earning or generating the net income. Now, the 100 minus 60 is equal to 40,000, and then we will deduct all fixed expenses for 30,000, and this equals to the net operating income for 10,000. Be careful that the net income will be the same, definitely the same, but the distribution or the places or the formats of the expenses will be different between the traditional and contribution. Again, the contribution format will stress, let's say, about the classification of the expenses between variable expenses and fixed expenses. So the contribution margin is the difference between the revenues and the variable expenses only. And after the contribution margin, we will deduct the fixed expenses. If I ask that question now, out of the 70,000 for the traditional format, what is the fixed and the variable components for the cost of goods sold? For the external users, it is not important to identify the components or the fixed components and variable components. They are considering the net operating income or let's say the gross margin and the difference or the importance of the selling and administrative expenses. For the managers, they are put a consideration for the variable expenses in order to calculate the contribution margin. So we need to know the contribution format for the income statement. Simply, we will deduct the variable only expenses, the variable expenses only from the revenues. And by the way, all variable expenses, either it is related to the manufacturing or non-manufacturing. in order to calculate something called contribution margin. And then we will deduct the fixed expenses in order to calculate the net operating income. The contribution income statement format is used as an internal planning and decision-making tool. We will use this approach for chapter 5, as I say, cost volume profit analysis. For chapter 6, segmented reporting of profit data out of our syllabus. The budgeting is important also, and it is in our syllabus. Chapter 8, we will use the format, the contribution format. In chapter 13, definitely we need to use the contribution format, special decisions such as pricing and make or buy analysis in chapter 13. So be careful about this format for the income statement. We will use it for chapter 5, 8, and 13, definitely. By this, we finalize chapter 1, and let's do some exercises related to the topics that we covered. Okay, then let's do some exercises about chapter 1. Exercise 1.4. I think I will start with 1.4. Okay. 1.4 is a little bit tricky, but important. Look, fixed and variable cost behavior. Fixed and variable cost behavior. Espresso Express operates a number of espresso coffee stands in busy suburban malls. The fixed weekly expense of coffee stand is 1,200. And the variable cost per cup of coffee served is $0.22. Required, fill in the following table with your estimates of the company's total costs and average cost per cup of coffee at the indicated levels of activity. Round off the average cost per cup of coffee to the nearest tenth of cent. Now, we have 3 columns, and the 3 columns represent the level of activity, level of cups, number of cups served. We have 2,000, we have 2,100, and 2,200. Look at the title, cups of coffee served in a week. Cups of coffee served in a week. So we have 3 levels or 3 levels of cups served in a week for that company. The fixed cost as a total, variable cost as a total, and then the total cost. And then we have to calculate the average cost per cup of coffee served. Fill in the following table with your estimates of the company's total cost and average cost per 1 cup. Let's do it together. Let's do it together. The first thing and easy thing to fill what is the fixed cost. Fixed cost. Then we need to fill in the total fixed cost. Remember that the fixed cost is fixed regardless of the levels. So we need to fill first these 3 numbers into what? Into these 3 numbers. Should be the same. Why? Because the fixed cost will be the same regardless the cups of coffee served. So the total fixed cost for the level of 2,000 will be 1,200 here, right? This number will be 1,200. The other number will be 1,200. The other number, the third number will be 1,200. Why? Because the fixed cost is fixed regardless of the level that we serve. So the first line will be 1,200, 1,200, 1,200, 1,200 for the three levels. Why? Again, because the total cost or the total fixed cost will be the same regardless of the level of activity served. Okay, so the first line we have 1,200 in the three levels. What else? What about the total variable cost, which is the second line? What about the total fixed? Let me open a new slide, and let me have table now. So the fixed costs will be, okay, let me write the 2,000, 2,100, give me a second. The three levels of activity are 2,000, okay, 2,100 and 2,200, okay. The fixed costs should be the same, which is $1,200 for the first level. For the second level should be $1,200 again. For the third level should be $1,200. Why? Because it is fixed regardless of the level of activity. Okay. What about the variable cost? Variable cost is not fixed. It should be different between the alternatives, right? Why? Because it depends on the number of cups that we serve. Okay, number of cups that we serve. Then we have to calculate the variable cost per or for each level. Then we will keep it now blank because we need to calculate the variable cost depending on the per unit. The per unit is given in the question for 0.22, which is 22 cents, 22 cents. So for the first level, we have to say 0.22 multiplied by 2,000. This equals to what? 440. Okay, this will equals to $440. Calculated from 0.22 multiplied by the level of activity, which is 2,000, right? 2,000. Let me underline this. Underline, okay. No, okay. Okay. For the second level, we need to say 0.22 multiplied by 2,100, which equals to $462. Again, remember that the 0.22 is constant because it was per unit. So 22 cents is a variable cost per 1 cup, and this will be constant per cup. 0.22 multiplied by 2,000 is equal to 440. 0.22 again multiplied by different level of activity, which is 2,100, will equals to 4,062. And the last one will be 0.22 again multiply by 2,200. This equals to 484. Be careful that for the fixed cost, it was fixed regardless of the cups served. For the variable cost, we need to use the per one, which is 0.22, multiplied by the level of activity, which is level of cups served. Then the total cost will equals to the fixed cost plus the variable cost. This equals for the first level 1,200 plus 440. This equals to $1,640. For the second level, this will be $1,662. $1,662. For the third level, this will be $1,684. Okay, which is the combination between the fixed and the variable, the summation or the sum of the fixed cost and the variable cost. The last line asked about the average cost per 1 cup served. The average cost per 1 cup served. In this case, we need to say the average cost per 1 cup is equal to the total cost divided by the cups served, which is the levels. For the first column, we say 1,640 divided by the 2,000. Again, 1,640 divided by 2,000. This equals to what? 0.82 cents. 0.82, which is 82 cents or $0.82. Calculated from total cost divided by 2,000 cups. For the second level, we say 1,662 divided by 2,100, and this equals to 0.791. And for the last one, we say 1,684 divided by 2,200. This equals to $0.765. $0.765. Okay. This was the average per 1 cup. Average per 1 cup. Okay. Average per 1 cup. Question number 2, if you remember. Okay. Question number, not 2. Number B from the same question. Number B from the same question. Number B from the same question, does the average cost per cup of coffee served increase, decrease, or remain the same as the number of cups of coffee served in a week increases? Look, the average decreases while the cups served increases. Why? Because the cost or the total cost divided by large number or increasing number. If we have 2,000, the 1,640 will be divided by the 2,000. So the average will be 82 cents. If we increase the number of cups served, then the average will be less. If we increase to 2,200, the number will be, or the average will be less. The point here, the fixed cost, which is constant, will be divided by bigger number or large number for the cups. So the average cost here, number B, the average cost of a cup decreases. Why? Because the number of cups increases. Because mainly the fixed costs, mainly because fixed costs is spread over more cups of coffee. Okay, more cups of coffee. Be careful that the per one is constant. The variable cost per one is constant. So the key here is the fixed cost. The fixed cost is divided or distributed over more cups of coffee. Okay. This was for exercise 1.4. Let's do the one six. 1.6 traditional and contribution format income statement. Cherokee Incorporate is a merchandiser that provided the following information. We have number of units sold, selling price per 1 unit, variable selling expense per 1 unit, variable administrative expense per 1 unit, total fixed selling, total fixed administrative, beginning merchandise inventory, ending merchandise inventory, and merchandise purchases. This question talks about the preparation of the income statement into two formats: traditional income statement and contribution income statements. So let's prepare the income statement depending on the traditional income statement. Traditional income statement. So traditional income statement we need to write down the name for the company, Cherokee Incorporate, then the name of the income, the name of the statement, income statement, traditional income statement for the period of something. We'll start with the sales, and the sales from the question we have 20,000 units multiplied by the price, which is $30. $30 from the question. The price is $30, and we sell 20,000 units, and this equals to 600. Okay, $600,000. $600,000. Okay, $600,000. Okay, after the sales, we have to deduct the costs of goods sold. Cost of goods sold. The cost of goods sold, we have two options to say that. If we have the cost per 1 unit, multiply by the 20,000, right? If we have the cost per 1 unit, multiply by how many units do we sell, then it will calculate the cost of goods sold. But for this question, we don't have the cost of goods sold as or per 1 unit, but we have the beginning inventory. Go back to the question if you like. We have a second mouse. We have the beginning inventory 24, we have the purchases 180, and we have the ending inventory for 44. So if you remember, the cost of goods sold can be calculated from what? Beginning inventory plus the purchases minus the ending inventory. So for this question, we will say the cost of goods sold is equal to what? Is equal to beginning inventory 24,000 plus 180,000, which is the purchases of the goods, minus the 44,000, which is the ending inventory. And this equals to what? to 160 thousands. 160 thousands. 160 thousands. Cost of goods sold is the beginning inventory, 24, plus the purchases or net purchases of the cost of goods purchased, cost of goods purchased for 180,000 given in the question, minus the ending inventory, which is 44,000. This equals to 160,000. 160,000. The difference between these sales minus the cost of goods sold will equals to what? The gross margin. So equals, or gross margin. Again, the difference between sales and the cost of goods sold is equals to gross margin. And the difference will be 440,000. 440,000. After that, we will deduct the selling and administrative expenses. Selling and administrative expenses. Be careful that the question, go back to the question, they give me the selling, look, they give me the selling or the variable per 1 unit, the selling per 1 unit and administrative per 1 unit, and they give me fixed portion for the selling, fixed portion for the administrative. Again, for the selling and administrative, we have variable parts and fixed part for each. If you like, we have, go back to the question, we have fixed selling 40,000 and we have $4 per 1 unit sold. For the administrative, we have 30,000 as fixed part and $2 administrative per 1 unit sold. So we need to explicitly write it down in the income statement. So selling expenses is a title here. Now we have two parts for the selling expenses. We have the fixed part, 40,000, and we have $4 per 1 unit sold. So if you like, we have $4 multiplied by $20,000 between brackets, right? And we will add the fixed part for the selling expenses, 40,000. Okay, so this will equals to 80 plus 40. This equals to $120,000 as selling expenses. Okay. What about the administrative expenses? Again, this is a title, and we have two parts for the administrative expenses. We have $2 multiplied by, between quotations, if you like, $2 multiplied by 20,000 units sold, plus we have 30,000 fixed part for the administrative expenses. This equals to 40 plus 30. This equals to $70,000. Okay, so the total for the selling and administrative expenses will equals to 190,000. 120 plus the 70, 190,000. The total for the selling and administrative expenses will be deducted from the gross margin, and this equals to what? To the net operating income. Net operating income, which is the difference between the 440 and the 120. This equals to $250,000. So the net operating income in this case will be $250,000. Be careful that we're talking about traditional income statement. Traditional income statement. Okay. Now, for the second component, we need to prepare the we need to prepare the contribution margin income statement. Contribution margin income statements. Okay. Okay. Maybe to draw a table is a little bit help our target here. Okay. For the contribution margin, we need to write down Cherokee incorporate contribution margin or contribution format income statements. Okay, contribution format income statement. Starting with the sales, same 30 or 20,000 units multiplied by $30. This equals to $600,000. $600,000. Okay. For the second line, for the contribution margin, we have to deduct what? To deduct the variable parts only. The variable parts, not all the expenses. So minus or less variable expenses or costs. Okay, variable expenses or costs, and then we need to pick what are the variable costs that we have. The cost of goods sold here, we have the 160,000 calculated from the previous requirements, 160,000. So we need to write down here the cost of goods sold. This is calculated, if you remember, 24,000 minus or plus 180,000 minus 44,000. Okay, then the cost of goods sold is a variable component, and this equals to 160,000. 160,000. Two columns just to be in formal income statements. Okay. And we need to add the variable parts for the selling and administrative expenses here. So we will say selling expenses, and we'll pick only the variable part. The variable part, in this case, $4 multiplied by 20,000 units. This equals to what? This equals to $80,000. $80,000. Similarly, we need to pick or to write down the administrative, the administrative expenses or costs. And again, we need to pick only the variable parts for the administrative. So $2 multiplied by 20,000 units. This equals to what? To $40,000. Okay. Now, the total for the variable expenses is equal to 160,000 plus 80,000 plus 40,000. This equals to $280,000. $280,000. Now, the difference between the sales revenue and all variable expenses will call the contribution margin. Okay, contribution margin. This equals to the difference between 600 and 280, and the answer is $320,000. $320,000. After the contribution margin, we need to list all fixed costs. So if you like, we have another title, so called fixed costs or expenses, same. And we say the selling expenses and the administrative expenses, but we need to pick only the fixed parts for these expenses. So the selling expenses from the question was $40,000, and for the administrative expenses it was $30,000. So the total fixed expenses from our question will be $70,000. The last step for preparation of the income statement is to deduct the fixed cost total, 70,000, from the contribution margin total, and this is called net operating income, and the answer will be what? $250,000. Be careful that we are talking about the same number calculated for the net operating income, but the format is different. So for the contribution margin format, again, we need to deduct all variable costs or expenses in the second here, in the second cell for the variable expenses, and we pick all variable expenses for the company. Be careful that the cost of goods sold is all from the question is variable. The selling expenses, we only pick the variable part, which depends on per unit, $4 per unit multiplied by how many units do we sell, and this equals to 80. Same for the administrative, we are paying $2 per 1 unit sold. This equals to 40. So the variable expenses for the company will be equals to $280,000. The difference between the sales and the variable expenses will equals to something called contribution margin, $320,000. And then we will deduct the fixed expenses to calculate the net operating income. That's all for now. That's all. Thank you. I will stop in after 1:06. We'll continue next time 1:07, 1:08, and maybe 1:09, 1:10 if we have a time, 1:11. Thank you.